When a business is sold, the structure of the transaction can significantly affect taxes, liabilities, and the overall outcome of the deal. One of the most important distinctions in business acquisitions is the difference between an asset sale and a stock sale. Understanding this difference is essential for any business owner preparing to sell. In an asset sale, the buyer purchases specific assets of the business rather than the legal entity itself. These assets may include equipment, inventory, intellectual property, customer lists, and goodwill. In most small and lower middle market transactions, asset sales are the more common structure. Buyers often prefer asset sales because they can select which assets and liabilities they want to assume. This allows the buyer to avoid certain historical risks that may be attached to the legal entity. For example, unresolved legal claims, tax liabilities, or undisclosed obligations may remain with the seller's original company. In contrast, a stock sale involves purchasing the ownership shares of the business entity itself. When a buyer acquires stock, they take ownership of the entire company, including all assets, contracts, and liabilities. Stock sales are more common when the business structure, licenses, contracts, or regulatory approvals make it difficult to transfer assets individually. For sellers, stock sales may sometimes provide tax advantages depending on the situation and jurisdiction. However, buyers typically conduct deeper due diligence before agreeing to a stock purchase because they are assuming the entire entity. Choosing the right deal structure requires careful planning, legal guidance, and strategic negotiation. Experienced advisors help structure transactions that protect both buyers and sellers while maximizing the success of the deal. EIN Business Brokers. We represent you in business sales and acquisitions. Confidential, structured, executed.